Welcome to the Mayor of Money podcast with former Burlington Mayor Rick Goldring of Goldring Financial Leadership. In this podcast, we provide successful business owners, including doctors and dentists, with insights to minimize tax and risk while maximizing retirement income and future legacy. Join us for this journey as Rick draws from years of experience and guest experts, including successful entrepreneurs, to provide unique strategies and approaches to estate and financial planning matters, as well as business in general. Now, on to the show.
We would love to have a sports podcast or a sports Facebook Live, but we're here to talk about money. And I'm Rick Goldring, former mayor of Burlington, calling myself the Mayor of Money. And I have a podcast that we upload every other Thursday about all sorts of information from entrepreneurship to wealth and estate planning, financial estate planning, different topics. But today is a very special Mayor of Money Facebook Live edition. We want to help you address some of your financial concerns with where we've been with regard to inflation, interest rates, financial markets, real estate. We know that there's some strain out there. There's lots of people mentioning some of the pressure they feel under, and we're going to help take down the pressure and take down the temperature and try to make you have a great summer by providing with you some education and some information that you can use as you see fit. In any event, I'm Rick Goldring of Goldring Financial Leadership, and with me today, my panelists are Brianne Gardner. Brianne is an investment advisor with Raymond James. Jivan Sangera. Jivan is a mortgage broker with Circle Mortgage Group, and Jamie Edwards and Sherry Police, both realtors with JM Edwards Associates. So everybody, a big welcome to the Mayor of Money special Facebook Live edition, and I'm going to go over to Brianne. A lot of people are obviously talking about financial markets, and when I look at current numbers, we see that the S&P TSX index is down 10% year to date. The S&P US index is down 18%. The bond markets are down 12, 13, 14%. And then, of course, we have inflation, and oil prices and food prices have gone up, and interest rates are gone up. How are your clients doing? How are the people that you're talking with doing with regard to some of the angst that may be there because of financial markets?
Yeah, I think consumer sentiment across the board is at all-time lows right now. So people are a little nervous. From an investment standpoint, it is normal for volatility. We see about a double-digit correction in the market every year, and single digit, so that could be around 5 to 7%, about 2 to 3 times a year. So after COVID in 2020, when we saw the market pull back 34% in 23 days, and then the recovery from there, which was really astronomical. People really got into the market and weren't used to that normal volatility. We never saw another pullback from 2020. So the market was overdue to take a little bit of a breather. And we are seeing, going into a correction pretty much since the beginning of the year. The NASDAQ, or the tech heavy sector, that carries a lot of the big names, Apple, Amazon, Google, as well as some larger growth tech names, is pulling back the most, around down 25% year to date. But that's because those sectors were the ones that came out of COVID and weren't as impacted. So their earnings shot up. And so now their price is coming down. That is kind of more in line with, picking up from a valuation perspective, a good discount. We are seeing, the market is also forward looking. So it prices in things 12 months in advance. So although we saw, we knew interest rates were going to start hiking, because when the economy starts heating up, interest rates go up. So then the Fed and Bank of Canada can cool the economy. So we did see the markets price that in. The bond markets priced in around 8 to 10 interest rate hikes. So that is normal to see the market pull back on that, pricing in that fluctuation. I do think that if we see inflation start to peak out, which we could start seeing now, we are seeing I mean, gas is still very high, but we are seeing gas prices start to slowly come down, and energy as well as housing prices start to slowly come down. So those two make up a large portion of inflation, or CPI, about 50%. So if we can see those two areas start to come down, I think we will start to see inflation cool, which means that the Bank of Canada and the Fed won't have to do as many interest rate hikes, which could be profitable for investors who are invested in the market. And we could see things start to rally. I think we're still going to see volatility throughout the summer, but maybe September we'll see markets start to turn around.
So great segue to real estate, because you mentioned real estate and the tremendous impact it has had on inflation, and that prices are supposedly easing up. So Jamie, Sherry, you work in the Hamilton, Burlington, and broader markets. What's actually going on with the markets in the area of Hamilton, Burlington in the last 2 or 3 months?
2 or 3 months, it is exactly like what Brianne said, is that it's starting to sort of level off. Now there's people that still have their rate holds in place. So those people are still actively buying right now. So they're trying to get through the remainder of the time. I find our senior markets are really watching, and they're trying to predict how low this is going to go. So they are tending to try and think that the market has dropped off far more than what it has in their price point. So it tends to be property specific. So in as much as what we're hearing that the whole market is starting to cool, it's different facets of it.
So which facets are cooling more than others that are holding?
The underlying markets definitely are. So for instance, we've been selling from Oakville to Niagara. So we're trying to go where people can afford. So it's the underlying markets, Niagara markets, and that are starting not to get the competition. But we are seeing a lot of stuff in Burlington sitting. There's a lot of yo-yoing of pricing, if you've noticed that. People are trying, low ball numbers to high numbers. You're seeing stuff coming off the market. We're starting now, because June 30th is your typical closing date of the year. We're starting to see some of the deals falling apart, coming back on the market now, because financing is not coming through.
And that's a great segue to Jivan.
Yeah.
Financing not coming
I was
through.
doing it for you.
Boy, those appraisers.
So Jivan, you've been a mortgage broker for a number of years. You're very experienced. You've worked with all sorts of different people in all sorts of different markets. What's going on right now in your mind, and what's the impact that you're seeing? How are people taking different action with regard to their mortgage and debt than they did a year ago?
So first off, thank you very much for allowing me to join you guys today. It's great to be with such strong voices and intelligent people. So thank you for letting me pretend I'm one of you for a few minutes. So, as a matter of the real estate market, mortgage interest rates, and what Canadians are experiencing right now, it's actually twofold. So one is as the Edwards Group just mentioned, there are files that are starting to fall apart. Now, touch wood, not here at Circle Mortgage Group, not one of our clients has not closed, but in other situations at other lenders and other brokerages that might be using more unscrupulous practices in their lending, things are starting to fall apart. I got a call last week about a deal that was in kind of rural Waterdown, Puss Lynch to be exact. People had sold a home out in Caledon, had expected it to close, were downsizing, expected to close without incident over here, cash. So they had no bridge financing arranged, they had no mortgage arranged, and the deal fell apart in Caledon. And the domino effect of that is huge, right? Because had they had a mortgage scenario in place with a bridge loan, they would actually still have been able to close. So the domino would have stopped in that one isolated scenario. But because they didn't, and they're 100% dependent on that sale, I can't even go get them a bridge loan right now because the sale agreement has lapsed. So, they're now in a litigious situation where on one side, they are just trying to close the home that they thought they had sold, and they were leaving, the original nest with $1 million in their pocket and a new home waiting for them. And now everything is in shambles. So, those situations are isolated. They're very, very isolated right now, but there are situations where people are not able to close. We had another scenario, Mr. Edwards mentioned appraisal values. Last month into May and, early June, appraisers were not necessarily adjusting for time, meaning that, they were allowing our analysis to just be based on the true X's and O's of recent sales without an adjustment for time. If you were to look last year, they were actually adjusting prices positively for time. Now you're moving into a scenario where they are going to start to adjust prices negatively for time. And what's happening is that, it would be my suggestion that if you're looking to sell your home, you do so sooner than later. Because with increasing interest rates, Canadians themselves only have a certain amount of money that they can slice up to all of their debts on a monthly basis. And as prices rise, I think you'll find that the mortgage portion of that debt is taking up too much space. And because of that, Canadians aren't in a position to spend as much as they would like to on that property. I was doing some quick research before we started this conversation today. Year over year sales from the Toronto Real Estate Board are down 39%. They're still higher than 2020, but compared to 2021, we're down 39% in volume in the Toronto area. I wasn't able to check the RAHB, but that's kind of what I'm seeing from 1,000 miles away. Another thing is the stress test, right? Where the stress test was traditionally something that was universal across the board. Now, depending on the product you're going with, you could be stress testing at a rate as high as 7.5%. So that's going to reduce what Canadians qualify for, and it's already having a pronounced effect.
So Jivan, you segued over to real estate, saying if you are thinking about selling, you may want to get on it now, as opposed to wait for a few months or wait for 6 months. Jamie, Sherry, what are your thoughts? You're in the business, you're the realtors. What are your thoughts?
It's just a hard call with it because I hate to put people on the street. I just had that circumstance happen, and I had young buyers who were affected by a rate increase to the tune of $80,000. So it really affected their buying power. We managed, I'm going to say a month ago, to get them into a house that would have sold very easily for 1.1, 1.2. They got it for $975. We turned around the following week as quick as we could, got their place on the market, and then it sat. So it was North End condo, Burlington, 700 square feet, 1 bedroom, 1 bath, and it just flatlined. So to give you an example, the best comp sold for $587. The week previous, 3 weeks previous, they got $540. But they, you have to talk them through it. You have to let them know that although their expectation is they're going to get what their neighbor got, they also made it at the other end. So, $975 detached house in Dundas, you got to look at the numbers.
So the deals that are closing June 30th, in a few days, really.
Yep.
Do you wait to June 30th to make sure they close, or can you take preemptive action to take a look at the set of circumstances, see if anything has changed?
No, we've got one that's closing that everybody's just holding their breath on right now, and we've been doing everything that we can do to ensure that everything's going to close. Our people have gone to sign everything off. There's no sign of a problem, and you usually find a problem like at least a week ago. So we're not hearing that there's anything happening at this point that it won't close, but we're hearing it all over the place. I know 2017 was just a very difficult time for people at that market, where it kind of collapsed Easter weekend. It was done. This hasn't been as more like a triple effect, that it's been changing because we've had the rate increases that have really affected people. And then also we've had people just sliding out of the market and going into the rental market.
From a historical point, Rick, I might want to jump in and just say, from a historical point, I've been doing this for 47 years, and there are always black swans that come in and disrupt. The pandemic was a black swan. The 2008 .com crash was a black swan. GST, when it came in 1990, we had no closings in the first 6 months. That was a black swan. Most people always think real estate goes up. It does not. And I was looking at the historical statistics. When I started, it was 45,000 average sale price. That should make you feel happy. And by 1980, it had gone up 143% for the decade. So from 70 to 80. In 1990, it had gone up 182% for the decade, that 80 to 90. Then you had 1990, and we had the GST brought in January of 1990. And we had an NDP government elected in Ontario. I don't want to make it political, but the economy stalled. And it was a difficult time. And I can tell you in that decade, the market actually declined 5.7% average sale price. People don't realize that whole decade, it didn't. And then after that, it's gone crazy. Now, remember in 2001, we had the 9/11. That's another black swan. So it impacts everybody. And we have to keep this in perspective that, and I've been saying it to Sherry and the clients that we have, newspapers love to report plane crashes. And I said, when the market turns, the newspapers are going to be all over this. And if you look at the headlines in the Globe or the Spectator or the Star, they're all jumping on this, oh, deals aren't closing and all that. They're looking for plane crashes. So for people out there, and I think, Jivan, you hit the point when you said there's few, but the ones that they have that are closing, they make a big issue out of it. 99% of them will close. So you have to keep a very positive look on this. My mandate's always been to pay off debt. And thank God, Sharon, I think that she thinks that way a lot more than I do, but get those debts down. That's why we do second mortgages and hold them now, Siobhan, because that's where we've done very well, helping other people out. And Rick, we're in a black swan right now, and I don't think it's as bad as people are saying. I'm looking at the stats right here for May. I mean, the average price was $995,000 in RAB, the Real Estate Association of Hamilton Burlington, which is up 17% from a year ago, and
Right.
87% from 2012. So yeah, does it need to level off? Of course it does. The average sale to listing ratio was 104%. That's insane. Like it usually traditionally runs about 97% of the asking price. So the pandemic has been an enigma in real estate, and people have got expectations, as Sherry mentioned. They got to get those expectations down. And I'll leave it with this point. You buy and sell in the same market. So as you say, put your house in the market, but you're buying, as Sherry said, they saved at $200,000 on what they bought. They had to take a little bit of a hit on what they were. For the move up buyer, it's great. For the move down buyer, seniors, they've got to think it through. And a lot of seniors have cashed out. I really feel for the family in Caledon because I can relate to that. They've cashed out, they want to downsize, and all of a sudden they own 2 properties, and it's not easy. So, but on a positive note, there's a shortage of supply. Rick, you were the mayor of Burlington, there's a shortage of land supply. They got to knock houses down and build. So if you're in that market, you're going to be good. The outlying area, that's more concerning.
Well, I guess when we do look at markets and the newspapers tend to report the broader markets as opposed to certain areas. But I still look at the city of Burlington with the fact that we're not going to be building many, if any, single family homes, single detached dwellings. So if you own a single detached dwelling, I think you're going to be somewhat isolated from real estate getting beat up. Yes, you get beat up, but let's put things in perspective. As you've been saying, over the last couple of years, real estate is up dramatically. So if it eases up, that's not to be unexpected. You can't have 50 or 60% increases in properties over 2.5 years and expect that to be sustainable. There's going to be some backup at some particular point. And the same thing, Brianne, we're going to go over to you and talk more about the financial markets. It's the same thing since 08, 09, since that, what Jamie was referring to, that Black Swan event with .com and with regard to the banking system in the States and other countries being challenged dramatically. That was a huge Black Swan event. But, since that point until recently, except for that big dip in the markets 2 years ago with the beginning of COVID, the stock markets, financial markets, bond markets had done phenomenally well. So what's been happening recently, again, isn't unexpected.
Yeah, I think, there is dislocation between the economy and the stock market. A lot of people see them move hand in hand, but they can, as we saw through COVID, one can move higher when the other one is pulling back. So yeah, I think a lot of investors were comfortable going into, depends on where you start, but to a 10 to 13 year bull market when the markets were rallying up. So you could really, even over the past 2 years, be in any stock, any sector. And as long as you were invested in the market, you were doing well. So we saw also the rise of the DIY investor. Everyone was staying at home. Everyone thought they were the best stock picker in the world.
DIY, do it yourself, correct?
Yeah, DIY, do it yourself. So, whereas now those people who, picked up maybe even a little bit more growthier names like DocuSign, Pinterest, things that were doing well in 2020, are down. Some of those names are down anywhere between 60 to 70%. So, are really getting hit hard. And that's why, I think it's crucial to have a good management team looking after your wealth, because you have to be able to plan. And I am more of an active manager. So we'll tactically trade through this and focus on risk management, but even a balanced portfolio right now, a 60-40, 60% equities, 40% fixed income, you'd be down around 14 to 16%. And that's also because the bond market has been hit so hard as well. So it's the worst year in over 100 years for the bond market. Even the benchmarks for bonds are down 10 to 15%. So if you were looking for safety, even as a retiree, up the ladder from, GIC, you'd go into more fixed income or bonds, and you'd be, thinking that your money was safe and could be down 12%, almost more than someone who had an equity portfolio. So that is really due to the rise in interest rates, because that brings down the price in the bonds.
So let's talk about that a little bit more, because I know a lot of people have struggled with the fact that when interest rates go up, it's bad for the bond market. And that's what we've experienced. We've significant sharp increases, but it's caused the bond market to go down. And I always explain it that if you're looking in the market and you want to invest some money in a bond, do you want to buy a new bond at 4%? Or do you want to buy an existing bond at 2%?
Yeah,
and you're
exactly.
going to you want to buy the new bond at 4%. And so in order for that 2% bond to be as attractive as that new bond at 4%, the value of the bond has to drop. And that's one thing that I know intuitively some people have struggled with, that when interest rates go up, bond markets go down. And when interest rates go down, it's good for the bond market because your bonds are that much more attractive. But what does the conservative investor do? And when you look at GIC rates a few years ago, we're paying 1.25%. And what were the options a couple of years ago, and what are the options now?
Yeah, so I think I strongly still believe, being invested rather than sitting on the sidelines is always the way over the long run. You've seen the charts, you've seen it. Yes, there are periods similar to the housing market where the market can lull, but if you are in active management, you can do well. And there are certain sectors that do well. I mean, energy still is up, double digits year to date. So not saying you need to be in a full energy, but a diversified portfolio. But yeah, other places you can be is, and as you mentioned, Rick, is in 2020, I was looking back as well. And for a GIC, I think the best we were getting is 0.9%. The banks on cash, anyone who had cash just sitting in the bank, the banks were giving them like 0.05% on your cash. Now you might get upwards of 1% for just holding money, cash in the bank. But I'm looking at GICs for, a lot of investors who had sold properties through this and kind of want to sit out of the market, but want to wait to see, maybe in the next 6 to 12 months. So want to still have that cash available. So I can see GIC rates now, with where interest rates have gone up, upwards of 4%, which is great. I mean, conservative money, if you can sit in cash and get 4%, that's amazing. So I think, we'll see in July, if the Bank of Canada does do the 75 basis point hike again, we could see prime peaking out around that 4.45. But if we do see that rate, then, even in July, you'll get more bang for your buck as well if you hold off a little bit longer and try and lock something in then. So even the 1 year, the 2 year GIC rates, there is a lot of good options presenting themselves. But also from an interest rate perspective, if we do go into a recession, which I know that's kind of headlines everywhere, whether it's 2023 or 2024, depending on what happens with the economy. The number one tool that the Bank of Canada uses and the Fed is that they cut interest rates pretty much back to zero to help stimulate the economy. So I don't see interest rates staying this high for, the next 5 years. As soon as we go, and I mean, we're seeing GDP numbers come out soon that could say we're already in a recession, because technically a recession is classified as 2 negative quarters of GDP growth. So if that does happen, we could see interest rates start to come down in 2020, late 2023, early 2024.
Okay, well, we're going to hold you to it. Jivan, I got a question. We actually have Jamie, when we did the show on Cogeco, we always got so excited and we got a question. Well, Jivan, we do have a question for you with regard to mortgages. And the question is, with regard to the pressure that people may be feeling now, when you're used to excessively low interest rates, you're not used to these little bit higher rates, and that may go higher still. Do you see 35 or 40 years mortgage amortizations coming back?
Well, thank you to whoever for that question. So 35s is already here. So there's 3 sectors to the market, right? You've got your CMHC insured lenders, your bank type A lenders, and then you have credit union and alternative lenders. Within the credit unions and alternative lenders, there's already products available that will allow for a 35-year amortization. Through the traditional market, though, 30 remains the cap. I would not be surprised to see legislation take place to allow for the 35 to return. It was actually in the B20 and B21 underwriting rules that was changed. So not to get too far into the minutia of it, but what they thought was that people were spreading themselves too thin back then, which is why they got rid of any insured mortgage. So anything with less than 20% down can only be done on a 25-year amortization.
Gotcha.
So, I wouldn't be surprised if you see that. And now that is if this is a prolonged scenario, right? So I subscribe to an economist that's in the market. His name is Benjamin Tall. I've always found him to be very practical and pretty spot on. So I was actually reading something last week where Benjamin was referring to the interest rates today and the prime rate cycle. It's almost a reverse U, meaning that it's rising very quickly and that it's likely going to have to tail off that way. And my correspondence and my advice to my customers in this time period has really been to stick with the variable rate mortgage, because much like selling a stock at the bottom of the market, locking into a rate today, into what I would consider be the top, to very close to the top of the interest rate market, you're truly crystallizing that situation. And what's going to happen is that once we do enter recession, as Brianne was mentioning, and I do agree with her sentiment that we may already be there, but once that happens, the number one stimulator that the Bank of Canada has traditionally used has been to reduce prime, much like they did during the pandemic when they dropped it to its lowest level ever. So I wouldn't be surprised to see something like that occur. The other thing is that with the qualifying rates today, people are actually qualifying for the largest mortgage using a variable rate. And that is because of that same B20 rule scenario where you have to qualify at either the quote unquote stress test rate, which is 5.25% today, or your contract rate plus 2%, whatever's higher. So just to give everybody some quick numbers, I was looking at some things before we got into our meeting today just to have some content. And one thing I noted is that on a family of $120,000 in income, which for Burlington might be a little low, but across the province is not too far off the mark for family income. If that person's trying to qualify with 20% or more down, we can use a 30-year amortization. As of today, on a variable rate mortgage, that $120K family would qualify for a mortgage of about $630,000. That's with 20% down. So that's somebody that's buying somewhere upwards around $800,000. The same scenario, same amortization on a fixed rate, that same family is only qualifying for $515,000. A difference of what, pushing 20%? difference in qualification level. Same thing with CMHC insured deals, you know, under 20% down. That same 120K family is going to qualify for a 570K mortgage because of the 25-year amortization limit. And then, but if they're going fixed, they're only going to qualify for 480. Again, a difference of $90,000. So when you're working with your realtor professional, you know, these are things that we have to be cognizant of. So as much as people would love to hedge, you know, I don't recommend hedging in this current situation. And by hedging, I mean taking a fixed rate or at least a longer term fixed rate of 5 years or more. I'm still very much a proponent of the variable rate mortgage because, again, as Brianne said, you know, it is a primary practice of the Bank of Canada to reduce prime in situations of recession. My biggest fear is a situation of stagflation, where we have an economy that's retracting with inflation that continues to grow. And I'm not sure if any of our, you know, modern economies are really set up to be able to deal with that situation. I'm also hoping that the Bank of Canada sees that the price of oil is not directly related to the prime rate. So maybe they could do some more to control the natural resource and supply side of things instead of just assuming that this one knob is going to fix everything.
Interesting. Brianne, do energy prices have further increases ahead?
We are actually seeing the energy sector, the XLE, which is just like the index, I guess you could say, the energy ETF, you know, is down over 20% now. So it has taken a breather. Oil sitting around 108, 109 levels. So again, I see this as a good opportunity. I mean, energy was hit the hardest through the pandemic as well. And then people started piling in, seeing it as a great sector to invest in. So I do see, you know, this commodity boom still continuing, energy still, but I think, you know, there's major support in oil around that $100 a barrel level. So I still think that, you know, we're going to have this volatility in oil, but the G7 is meeting. So, you know, we'll see how everything goes and everything with Russia and Ukraine as well. You know, there's some geopolitical concerns with the sector, but I think we're still going to see it recover from here.
Brianne, when you meet somebody, a new prospective client or a new client, somebody that's joining you, what sort of process do you go through to determine the type of portfolio they have? I'm familiar with all these questionnaires where, you know, are you a low risk? Are you medium? Are you high? If this portfolio did this, another one did this, which one would you like? What are the tools now for you to help, for a client to define to you what sort of asset mix and how aggressive or how conservative their portfolio should be?
Yeah, I mean, questionnaires, I think, you know, our questionnaires, people can answer them however they want. So we have to do some for compliance standpoint, of course, but, you know, what we like to do is talk about experiences that a client has had. If they have been through 2008, through 2015, through 2018, through 2020, you know, and what did they do? How did they feel? Did they sell out at the bottom? You know, were they nervous? And then kind of get an emotional read for that as well. Also, depending on the income needs that they need, you know, are they a retiree that they need this stable income to really last, you know, from now until they pass away. So we do a financial plan for all of our clients, which kind of helps create that starting point of where they are now, where they want to be, and map that out to see if there are any shortfalls in the plan. And really, it's important to have conservative numbers for that, so that when we do go through periods like this where the market is pulling back, you know, it offsets those years where the market is up double digits and kind of levels out. So, you know, even using a 3 to 4% average return when the markets have annualized around 9 to 10, I think it's always good to have a little bit more conservative numbers for those projections. Something else that we do invest in on our team is called financial DNA. So it lets you understand a prospective client on how to communicate best with them. If they're big picture, want to see the broad, if they want to get down to the nitty gritty on the stocks that they hold and the sectors and why, and see the charts. And then the same thing, it's how they would react emotionally for markets like this.
And Jamie and Sherry, when you're sitting down with somebody who wants to get into the market, they're looking at their first type of investment in real estate or first purchase for for a home, what sort of questions do you ask, and how do you guide them as for the market that they should go to, or the type of product that they should be directed to?
It's very similar, really. We're sort of getting a bigger picture idea of who they are and what their goals are. I like to look at, if it's a couple, the personal questions you ask. Are you planning on having a family? Because what I like to do is sort of structure it so that they can be there for 5 to 7 years. I look at a 3-year plan, but you don't want somebody under housing themselves. So it's more or less what their longer term goals are. Are they going to be piggybacking? Sometimes they can jump right into the bigger house. So that's going to save them a ton of money if they can do that. So it's that type of question, is just what are your goals, and what are you, do you have student loans, that type of thing.
And as far as single, somebody, we all grew up in single family homes. And it's tough for people to think that they could raise their family. If they grew up in a single family home, it's tough for them to think that they could raise their family in anything but a single family home. So if people are interested, I guess it depends on how much money they have and how much money they're earning. But what are the options for people grew up in Burlington that want to stay in Burlington or as close? How do you advise people if they want to stay in Burlington no matter what? How would you advise them? And if they're willing to go somewhere else, how would you advise them?
Well, we start off showing them houses. Like, we go through the financial part of it as much as what we can. I like to get them started with a mortgage broker. Go down and investigate different options on how you're going to purchase. Sometimes it is parents helping them out. Sometimes it's co-housing now. So maybe a brother and sister want to get together and buy a house together, and then they can branch out from there. I've got a couple of that going on right now. So, where there's a will, there's a way. They have to know that they're going to save. So I always like to tell people, like, try and budget for what is going to become. So start living your life in your townhouse or your rented place. Start living your life like you own a house right now. Because they need to realize that they can't go out for dinner every night. They've got to start pinching pennies a little bit. So it's just, they will sometimes end up going outside of their desired area. Burlington's tough.
Burlington's tough. Hamilton's more challenging
really
than it's ever been
right now. Yes.
It's challenging in the Southern Ontario area, that's for sure. Now, I do have another question, and I'm not sure if I understand. I'm just going to read it, but it says, is the first-time home buyer incentive that offers 5 to 10% of the homes purchased for down payment, does it even help with houses going way over asking in Southwestern Ontario? Are they going over asking still? Are homes going over asking?
Some are. But if I could talk to your buyer incentive question there. So the first time buyer incentive was a shared equity program. What's funny about that program is in more cases than not, you actually qualified for a larger mortgage without the incentive. And the reason is they artificially limited gross debt service in that situation to 35% on a 25-year amortization. So traditionally, with a credit score above 620, you can go up to a 39% gross debt service ratio. So what you were doing is you were actually limiting yourself by about 4% of what you qualify for, just by virtue of using that program, not taking into account the fact that the government officially would own part of your home. So that was a great pre-election headline sort of program. They used less than 5% of the funds available in that program for actual distribution. So the program itself was a monster flop. It worked well in areas that are not in Southern Ontario. But here in the GTA, where we actually needed some of the most relief, it did nothing for us. Quite simply, it's the best way to put it, is it really did nothing for us. And now they're actually talking about curtailing the program based on declining property values. So in true government fashion, when they saw that the roller coaster ride was only headed upwards, they wanted to get into that action, thinking that they had a masked program that would allow them to share equity in Canadian homes without a capital gains tax. And And what ended up happening is that the structure of the actual program made it a non-incentive. Very, very few people took it. If you think about it on a, I believe that the cap was somewhere around $500,000. But if you think about it on, that 5% difference in down payment, representing in that scenario about $25,000, your net savings on your mortgage payment are under $100 a month. So, I thought the Edwards Group made a really interesting point about, adjusting your lifestyle to reflect what your payments are going to be. And it kind of leans back to that whole conversation about only having a certain amount of pie to be able to split up on a monthly basis. And as, the real cost of life increases via inflation, and you have interest rates increasing as well, something's got to give. And in most cases, what's going to end up giving is the housing and shelter portion of that transaction. Not getting into the kids that are no longer going to be able to play hockey, soccer, baseball, and all these sort of, disposable income activities that we've all been fairly flush with. I think that you're going to start to see pullbacks in those programs. And then, again, the Edwards Group can speak to, I'm seeing some of our highest price point homes in these areas going through serious degradations in value, like I'm talking pushing 30%. I may have even mentioned it to you, Rick. There was a house in North Burlington that had started over $4 million. They dropped their price at the end of May to $3 million and got no offers and took it off the market. And, I was sort of kind of interested in that house. So I'd done some research on it. If they had sold that house for $3 million, they would have been about $800K short with all the financing registered on that place.
Wow. So
that's not going to happen. So that home has come off the market, and those people will look for a different way to make themselves whole. But the point is that, again, canary in the coal mine, right? So higher, and again, the Edwards Group would be able to speak to this. It's in my experience, in my 20 years of doing this, that it's usually the highest price point properties that are affected first, because those are the people that are most protective of their capital. And I think that you're starting to see that take place. So, as a matter of how long will this, lull in prices occur, as prime continues to increase, again, people only have so much money to spend on a monthly basis, and it may require housing prices to fall for them to be able to accommodate these purchases at all. But like you said, you're saving money on the top end of your transaction, and what you're losing on the bottom end of your transaction is likely less as a percentage compared to where you're buying at.
So during the height of the pandemic, some of the financial institutions tried to make it easy for some people that were going through some tough times financially because they were unemployed, they're working at home, their revenue wasn't as much, whatever the set of circumstances were. And people were allowed to defer payments, skip payments, whatever the circumstances were. So what about now? You have somebody that's squeezed, they've got their maybe they have a variable rate mortgage, maybe they don't, maybe just the fact that because of inflation or whatever reasons they're getting squeezed. Do current mortgages already in place, is there any flexibility at all that the financial institutions provide for people that are under the gun financially?
Absolutely. One thing Canadians may seriously consider right now is taking a look at the skip a payment features in their mortgage documents. So it's not available at all lenders, but most major A-type lenders do have a skip a payment feature, where, as an example, you could skip up to 4 payments where they capitalize the actual payment to the end of the mortgage, and it's taken care of at that time. Now, lenders never look favorably at this, but at the end of the day, this is life. So, much like people were taking advantage of the postponement of payments during the crisis of up to 6 months, and that allowed people to get through. I was reading recently that the NDP party is suggesting that $1,000 a month kind of inflation fund be established where Canadians can get $1,000 a month from the government tax-free to help them cope with this, right? Because literally all we are doing is coping. Right? We are not in a position of power where we can truly affect it. In most situations, for Canadians that with non-indexed wages, which what I'd say probably well more than 3/4 of our economy is in a non-indexed wage, we are all technically poorer than a year ago because our money is worth less. And until that is solved, and until we can kind of bring that into control, I think that we're going to kind of continue to, I would suggest to save as much as you can on a regular basis. There's amazing investment opportunities available right now, and that Canadians just do their best to cope versus necessarily trying to take advantage of this situation.
Gotcha. Brianne, with regard to your particular situation and who you advise, you have people of all ages. I'm sure your clientele tends to be older because that's where the money is. But when you're working with younger people today, is there a different approach other than the time frame they have for investing than there is with people much closer to retirement or people in retirement?
Yeah. My focus really is on kind of that multi-generational family wealth. So keeping as much money in the family's pocket as possible through different generations. So the first generation might have built it, earned it, and passing it down. Obviously, other generations are working as well, but just trying to keep as much money within the family and give less to the government. I think from a age and perspective, some younger investors are still conservative. And what a lot of our job is to do is to educate people as well. So to help them understand about volatility, about bear markets, about recessions, how things move in cycles, how there is a business cycle. But we do see, people who are younger, who have longer time horizons, can be have a little bit more exposure to the stock market, knowing that they can weather the storm. Again, if they do need the purchase in a year for a property, I would not be investing, taking that risk to invest in the market. But if they have a longer time horizon, then usually we do see a little bit more equity exposure or in stocks for those younger investors.
And what about with regard to younger people in the market with regard to housing? And are the people's tastes, what they want different than they were of younger people in their 30s 30 years ago?
I think, the pandemic was also another big awakening, right? You saw a lot of young people living in condos, whether you're in downtown Toronto or downtown Vancouver, which I kind of look at as the two major hubs across Canada. So if you saw, then we are starting to have kids. Millennials is becoming the largest demographic now. So that age group is now looking for more space. And a lot of people now are doing hybrid work. They need that space. They want to be in the suburbs. So a lot of millennials thought that the baby boomers or the older generation were going to downsize their homes. And the idea of what was going to happen was that you would see an influx of larger single home properties on the market, and that would give the millennials a chance to come into the market and buy those homes. But you're not seeing that. You're seeing people stay in their homes longer. You're seeing, a lot. My grandparents both stayed in their homes 92, 94 until they passed away. So, you aren't seeing that shift. And a lot of high rises went up in those major cities, thinking that, they would downsize to condos and be okay with that, but they're not. And now you're also seeing early gifting of homes. A lot of people are helping the next generation with down payments on properties, or some families I'm seeing are keeping them in trust and going to give their house to their children because they're worried about affordability. So I do see that, the 1 to 2 million mark, obviously just under $1.2 million is kind of that sweet spot, I think, in the GTA area. As kind of Jivan mentioned, that you are seeing prices in the larger, and we saw this in Vancouver too a few years ago, that $5 million properties, those are the ones that are going to get hit the hardest. But a lot of people have that similar price point of one, the higher end $1 to $2 million properties. I don't think those ones are going to be hit as hard.
So thank you for answering that question that I actually meant for Jamie and Sherry. But you did a good job. You did a good job with that. So I guess my question, Jamie and Sherry, is and thank you, Brianne. And my question for Jamie and Sherry is the 30-year-old of today and what they're looking for I know prices has something to do with it compared to the 30-year-old 30 years ago. Is there a difference other than the pricing as far as the type of property?
Sherry? I'm going to give it to you because 30 years ago was I'm giving it to.
Yeah, there is a chance. But Rick, you've got to look at the market and what's available to it. And I think I want to compliment Brianne on her graphs there.
Bang on.
Because
you're bang on.
90 right size or downsize. So we're talking people my age group. Do they right size? We call it right sizing, downsizing, or whatever. 93% of Canadians want to stay in their home. 93%. 51% of the people that are my age group want, and this is the retirees, they want to stay in their area. So what's available if someone sells? They got to go from Caledon to wherever they move to, or do they move from Burlington, say, out to Grimsby or Niagara Lake? And we're seeing a lot of movement that way. 51% want to stay in the area. 55 years plus is 42% of Canadians. Interesting statistic. 66% of retirees still carry debt. Now, Brianne, you might want to, and 20% still are paying a mortgage. It's scary. So the 30-year-old today, their expectation has had to change because the single family home was available. Rick, throughout my entire career in real estate, we always competed with new home developments, be it Head and Forest, be it Millcroft, be it, Mattamy up in Milton. This has not happened in single family detached homes in the last 5 to 10 years because there are no single family lots available. This whole idea of intensification, build up, not out. You and I've had those discussions because there's land in the area that they call the green belt, which is not practical green belt. It should be developed. It should be houses. And that's driving prices up. And when people say to me, well, I don't want any more, I don't want more intensification in Burlington, for instance, the downtown core, it's very busy and the pressure's on. So basically the answer is you aren't paying enough taxes because you don't want intensification. In other words, your taxes are going to go up to support what we have. And if they start to look at it from that concept, but to go to the 30-year-old, what they wanted in a single family detached house with a picket fence doesn't exist for them today.
So are they willing to go to a townhouse? Are they willing to go to some other form of ground-oriented housing other than the traditional single family?
Well, they have to, but I'll let Sherry answer that question.
Well, they have to, but it depends on their plan and their long-term goal and whether or not they're in a hybrid situation for work. I mean, there's so many different factors to it. There was an expectation that there was going to be single detached coming on the market and an influx of it. But part of it is, I feel, the millennial market itself is kind of split in the sense that there are a lot of millennials living at home still. So then you have the ones that have done really, really well that want to move on, but now are faced with the fact that they need almost a 4 or 5 bedroom house because they're both working from home. So during the pandemic, I saw a lot of desks underneath, like in crawl spaces almost underneath the stairways in the basements, just tucked everywhere that they could find an office space with 2 people trying to work from home and trying to online school with their kids. It was a very difficult scenario. So now they're looking for the larger houses that aren't on the market. So there's such a shortage of that right now, which is why you start seeing areas like Grimsby has gone nuts because it's the pricing that they can afford now. And that stuff is hitting the $1 million mark for detached.
The scary thing now, Rick, is now gas is $2 a liter. So all these people, as they're getting called back into their office, now are facing the price of transportation, $800 a month, and they can't write that off. That's an expense they have to pay. That's huge. And so will there be a movement back into the condos in downtown and the intensification? It's hard to say because once people get out in the country and they get that lifestyle, they don't want to give it up. They want that space. That's what we're experiencing.
So in the few minutes we have left, I'm going to give you each some time just to wrap up with regard to anybody that's feeling some angst or some anxiety with where real estate has been, where it might go, and with regard to interest rates and debt, and with regard to financial markets. So Jivan, we'll start with you.
For sure. So just to cap off what Brianne and the Edwards Group had said there, the main thing that I find 30-year-olds asking their parents for is not a increase to their down payment. It's a cosign. Just to show. So it's not that they necessarily need your nest egg. If anything, they need your recurring income to get their gross debt service into line, which is kind of the most helpful thing a parent could do in this market. The other good thing about that is as a co-signer, if there's anything goes sideways, the parent is notified and can deal with the pride factor and make sure they help out in whatever way that they feel comfortable doing. You know, in conclusion of our conversation today, Rick, I would say that more than anything, Canadians just need to remain cognizant of their expenses on a monthly basis. The cheap money days are not over, right? A 2.8% variable rate today is still hella cheap money. But the point is that if that increases another 75 basis points, we're looking at a 3.55% variable. I could tell you in my career, I probably haven't seen that high a variable rate in about a decade. And, you know, as a matter of what we're getting into, again, I see that my fear is around increasing rates that are not affecting inflation, and that our banks and the Bank of Canada is going to continue to use that singular tool to try and cool what they believe to be an overheated economy. I believe that our unemployment rates are at some of the lowest in history. And then if you were to take out a lot of things in our CPI as well, inflation year over year is closer to 4.5%, not 7.7, which is going to be the magic number everybody's going to hear for the next 30 days. And remember that that's not a month over month increase, that's year over year. So again, this is a headline economy. Very much so that people just depend on headlines for their news, and they're not necessarily diving into the actual substance behind those headlines. So I think now more than ever, it's really important to have professionals on your side, especially ones that are willing to help you navigate this market and not necessarily charge you to do so. I believe professional advice right now is more paramount than it's ever been before, and that Canadians should not walk alone. And that's really all I have to say. But thank you for your time today.
Thanks, Jivan. Jamie, Sherry, parting comments?
Hi, Sherry.
Very similar. I think that people just need to be realistic with what their budgets are. They need to look at longer term goals rather than the short term, I want. You need to sort of start making sure that your dollars are going to make sense down the road. Because I look at things as a longer term. I look at 7 years, what's your life going to be like in 7 years, not necessarily 1 year, so that they're making the best decision that they possibly can with their money.
I'll just add, Rick, I'm from a different generation almost. Take a deep breath. We've been through a lot worse than this. I mean, in 82, interest rates were 18%, and you had no options. It was 5 years fixed. That was it. So there's so much flexibility today, and just let it be. Take a breath, let it be, step back. You still got your house, but as Sherry and Jivan said, you know, maybe limit your expectations a bit. And that goes for sellers too. They've got to lower their expectations. It's a different time.
Brianne.
Yeah, I mean, I have done a lot of work on the pricing in the home market versus the equity market as well, and the long-term trends. I do agree with everyone on this panel that, you know, the growth we've seen, 30-40% growth in 1 year is not sustainable. And, you know, I still, a lot of Canadians, majority of their money is in real estate. So I do see, you know, cracks in the real estate market. I still think if people need homes as there to live in, then, you know, you still have to live there. From an investment standpoint, you know, they are the experts. Maybe, you know, it is time to kind of sit on the sidelines for a bit until it becomes a little bit more stable. But similar to the markets, right? You go in ebbs and flows, and we are going through a correction. Technically, went through a bear market, but 12 months from now, anytime you see a 20% correction in the stock market, historically, the 12-month forward-looking return is around 22%. So again, if you're getting in, you never know where the bottom is. But it is favorable to be invested and to get invested and to ride it out if you do have that longer term time horizon, and can kind of sustain. But I do see, again, volatility to continue as we see inflation start to figure it out over the summer. We'll see what the numbers come out in July. But then I see, you know, the fall, I do see things start to looking to turn around.
Well, listen, Brianne Gardner of Raymond James, thank you very much. And Jamie Edwards and Sherry Police of James Edwards Associates Realtors and Jivan Sangera of the Circle Mortgage Group. I want to thank you all for being with me today on this very first Mayor of Money special Facebook Live edition in an attempt to help people diminish anxiety levels, certainly through the summer and if not beyond. We want you to enjoy the summer. We wanted to provide you with some information and some wisdom from people that have been around for a while, that have advised people in many different areas for a long time. And we hope this has been helpful. And I'd just like to add something. If you're really feeling you're under the gun financially and it's causing some mental stress and strain, do a gratitude exercise. Every morning when you get up, write down 10 things you're grateful for. And I'm grateful every morning for so many different things, including the fact that we live in a great country. And Friday, July 1st is Canada Day. And we all have something to be grateful for and thankful for and something to celebrate on Canada Day. So enjoy your summer. Have a great Canada Day. And we wish you all the best. And if you have any questions for any of the panelists, I would suggest the best way to get in contact with any of them is through me at rick@rickgoldring.com. Otherwise, you can look them up and find them and connect with them directly if you so choose. But thanks for tuning in to Facebook Live, and we'll see you again next time.
Thanks,
Thank you,
Rick.
everybody.
Thank you.
Thank you for listening to the Mayor of Money podcast. Click the subscribe button below to be notified when new episodes become available. If you'd like to have a one-on-one discussion with Rick or have an idea for a particular guest or topic, contact him at rick@rickgoldring.com. See you next time on the Mayor of Money podcast.